Let me tell you about a conversation that changed how I think about retirement investing. It was Thanksgiving dinner about 15 years ago. My father pulled me aside after the meal. He had just retired after decades of working, and he had managed to save about $200,000. He looked at me with this mixture of pride and fear in his eyes and asked, "What should I do with this money? I need it to last the rest of my life." Now, I manage billions of dollars for sophisticated institutional investors. I have made and lost fortunes on complex trades that most people have never heard of. But standing there with my father, I realized that investing his retirement savings was an entirely different challenge. This was not about maximizing returns or beating some benchmark. This was about making sure the man who raised me could live with dignity and security for the rest of his days. That conversation forced me to strip away all the complexity and think about what really matters for someone investing for retirement, and what I discovered surprised me. The strategies that work best for retirees are not complicated, they are not sexy, they will never make headlines, but they work. They provide income, preserve capital, and let people sleep at night. Today I am going to share exactly how I would invest $200,000 for my parents' retirement if I had to do it right now. This is not theoretical. This is the actual framework I would use for people I love, people who cannot afford to lose their life savings, people who need their money to work hard without taking unnecessary risks. Before I reveal the specific investments, let me explain the principles that guide this approach. Because without understanding the why behind the portfolio, you will not have the conviction to stick with it when things get difficult, and things always get difficult at some point. Principle 1 is that capital preservation comes before capital appreciation. When you are retired, you cannot replace lost money. A 40-year-old who loses half their portfolio in a crash can recover through future savings and a longer time horizon. A 70-year-old cannot. The money you have is the money you have. Protecting it is more important than growing it aggressively. This does not mean hiding under a mattress. Inflation will destroy the purchasing power of cash over time. You need your money to grow, but the growth needs to come with appropriate risk management. I would rather earn 7% with low volatility than 12% with stomach-churning swings. Principle 2 is that income matters more than total return. Retirees need to pay bills. They need predictable cash flow to fund their lives. A portfolio that generates consistent income removes the stress of worrying about market timing. You do not have to decide whether now is a good time to sell shares. The income just arrives quarter after quarter, year after year. Income also provides psychological stability during market downturns. When your portfolio drops 20%, but your dividend checks keep arriving, you can stay calm. The income stream is tangible proof that your investments are still working for you, even when prices are down. Principle 3 is that simplicity beats complexity. Complex strategies require constant monitoring and adjustment. They create opportunities for mistakes. They generate fees and friction. For retirement money, simple is better. A portfolio you can understand and manage without a PhD in finance is a portfolio you can stick with for decades. Principle 4 is that time horizon matters even in retirement. If you retire at 65, you might live another 30 years. That is a long time. Your portfolio needs to handle inflation, market cycles, and unexpected expenses over that entire period. This means you cannot completely avoid stocks, even though they are volatile. You need some growth to maintain purchasing power over decades. Principle 5 is that fees are the enemy. Every dollar paid in fees is a dollar that does not compound for your benefit. Over 30 years, even small fee differences create enormous wealth gaps. I obsess over minimizing fees for my parents in ways I might not. For institutional money, every basis point matters when the stakes are this personal. Now let me show you the actual portfolio. I am going to break this into 5 components, each serving a specific purpose. Together, they create a retirement portfolio that generates income, preserves capital, grows over time, and provides peace of mind. Component 1 is what I call the Dividend Aristocrat Foundation. This receives the largest allocation, about $80,000 of the $200,000. This is the bedrock of the portfolio, invested in companies that have raised their dividends every single year for at least 25 consecutive years. Why dividend aristocrats? Because a company that has raised its dividend for 25 years has proven something extraordinary. It has survived recessions, financial crises, wars, pandemics, and every other challenge the world threw at it. Not only survived, but continued returning increasing amounts of cash to shareholders every single year. That track record is not luck. That is a durable business model and disciplined management. The list of dividend aristocrats includes names you know: Procter & Gamble, which makes Tide detergent, Pampers, diapers, and dozens of other products people buy regardless of economic conditions. Johnson & Johnson, the healthcare giant with pharmaceutical, medical device, and consumer health businesses. Coca-Cola, whose products are consumed billions of times every day around the world. These are boring companies. That is exactly the point. For this allocation, I would buy a dividend aristocrat ETF rather than individual stocks. The ProShares S&P 500 Dividend Aristocrats ETF or similar funds provide instant diversification across 60-plus dividend aristocrats with a single purchase. The expense ratio is around 35 basis points, which is reasonable for this specialized exposure. At current yields, $80,000 in dividend aristocrats generates roughly $2,000 per year in dividend income. Not spectacular, but reliable and growing. These dividends have historically increased at rates exceeding inflation, which means your income grows over time even without adding new capital. The companies in this allocation are not going to double next year, but they're also not going to go bankrupt. They are going to keep paying dividends, keep raising those dividends, and keep compounding wealth steadily over decades. For retirement money, that consistency is worth more than excitement. Component 2 is the high-yield bond allocation. This receives $40,000 or 20% of the portfolio. This is where we juice the income above what dividend stocks alone can provide. Now, high-yield bonds get a bad reputation. People call them junk bonds, which sounds scary, but the reality is more nuanced. High-yield bonds are simply bonds issued by companies with credit ratings below investment grade. They pay higher interest rates to compensate for higher default risk. The key is managing that default risk through diversification. When you own a single high-yield bond, you are taking significant risk. If that company defaults, you could lose most of your investment. But when you own hundreds of high-yield bonds through an ETF, the math changes completely. Yes, some bonds will default, but the higher interest payments from the rest more than compensate for the occasional loss. Historically, diversified high-yield bond funds have delivered equity-like returns with lower volatility than stocks. The current yield on high-yield bond funds is around 7 to 8%. On $40,000, that generates roughly $3,000 per year in income. That is meaningful money for a retiree. I would use a low-cost high-yield bond ETF for this allocation. The iShares iBoxx High Yield Corporate Bond ETF or similar funds provide broad diversification across hundreds of bonds with expense ratios around 50 basis points. One important consideration is interest rate risk. High-yield bonds are less sensitive to interest rate changes than investment-grade bonds because their prices are driven more by credit risk than rate risk. This actually makes them more suitable for the current environment where rates could move either direction. Component 3 is the utility and infrastructure allocation. This receives $30,000. Utilities and infrastructure companies provide essential services that people need regardless of economic conditions. Electricity, water, natural gas, cell towers, pipelines. These are not discretionary. You do not cancel your electricity bill during a recession. This essential nature makes utilities remarkably stable businesses. Revenues are predictable, cash flows are consistent, and most utilities pay substantial dividends because they operate in regulated markets where they cannot easily reinvest for growth. The cash comes back to shareholders instead. Utility stocks typically yield 3 to 4% higher than the broad market. They also tend to be much less volatile than the overall market. During the 2020 crash, while the S&P 500 fell 34%, many utility stocks fell only 15 to 20%. That reduced volatility helps retirees sleep at night. I would split this allocation between a utility ETF and an infrastructure ETF. The Utilities Select Sector SPDR Fund provides exposure to electric utilities, water utilities, and gas utilities. A global infrastructure fund adds cell towers, pipelines, toll roads, and other essential assets. Together, they provide diversification within the essential services theme. The income from this allocation should be around $1,000 to $1,200 per year, but the real value is stability. When markets are crashing and your dividend aristocrats are down, your utilities will likely be holding up better. This diversification smooths out the overall portfolio performance. Component 4 is the Treasury Inflation Protected Securities Allocation, or TIPS. This receives $30,000. TIPS are government bonds whose principal adjusts with inflation. If prices rise 3%, Your TIPS principal increases 3%. This provides explicit protection against the erosion of purchasing power. Why is inflation protection so important for retirees? Because inflation is the silent killer of retirement security. If your expenses rise 3% annually due to inflation, but your income stays flat, your standard of living declines every year. Over 20 or 30 years, this compounds into a dramatic reduction in purchasing power. TIPS provide guaranteed inflation protection backed by the full faith and credit of the United States government. There is essentially no credit risk. The only risk is that inflation stays low and you would have been better off in nominal bonds. But that is a risk I am happy to take for retirement money. The insurance against high inflation is worth the potential opportunity cost. Currently, TIPS yield about 2% above inflation. On $30,000, that generates around $600 in real inflation-adjusted income. It does not sound like much, but the key word is real. That income maintains its purchasing power, regardless of what happens to prices. I would use a TIPS ETF rather than individual bonds for simplicity and liquidity. The iShares TIPS Bond ETF or similar funds provide broad exposure with low fees. Component 5 is the cash and short-term treasury allocation. This receives $20,000 or 10% of the portfolio. This is the liquidity buffer that ensures my parents never have to sell investments at bad prices to pay bills. I know what you are thinking. Cash earns almost nothing. Why hold 10% in something that barely grows? Because cash provides options. Cash provides security. Cash means never being forced to sell stocks during a crash to pay for groceries or medical bills. The rule of thumb I use is to hold at least 2 years of living expenses in cash and short-term treasuries. If my parents need $40,000 per year from their portfolio, they should have $80,000 available without selling stocks. But since we are starting with $200,000 total, I scale this down proportionally to $20,000, representing the liquidity buffer concept rather than the full amount. Currently, money market funds and short-term treasuries yield around 5%. That $20,000 generates about $1,000 per year. Not exciting, but not nothing either. And the stability and optionality are worth far more than the yield alone. Now, let me add up the income from all 5 components. Dividend aristocrats generate $2,000. High-yield bonds generate $3,000. Utilities and infrastructure generate $1,200. TIPS generate $600. Cash and short-term treasuries generate $1,000. The total is roughly $7,800 per year in income. On a $200,000 portfolio, that is an income yield of about 3.9%. This is a sustainable withdrawal rate that should preserve principal over time while providing meaningful income. And unlike drawing down principal, this income should grow over time as dividends increase and bonds mature and roll into higher rates. But wait, you might say, $7,800 per year is not enough to live on. How do my parents actually fund their retirement? The answer is that portfolio income is just one component of retirement funding. Social Security provides the foundation for most retirees. If my parents claim benefits at full retirement age, they might receive $30,000 to $40,000 combined annually from Social Security. Add the portfolio income, and they are approaching $50,000 per year. For many retirees, that is enough to live comfortably, especially if they own their home free and clear. If more income is needed, there are options. They could gradually draw down principal using a 4% rule approach. On $200,000, that allows $8,000 per year in withdrawals beyond the portfolio income. Combined with Social Security, this could push total income towards $60,000 or more. The key is that the portfolio structure I have described provides flexibility. The income is reliable and growing. The principal is protected. My parents are never forced into a bad situation by market timing or liquidity needs. Let me talk about rebalancing and ongoing management, because even a simple portfolio requires some attention. I would review the portfolio quarterly and rebalance annually. Rebalancing means selling what has gone up and buying what has gone down to return to target allocations. This sounds simple, but is psychologically difficult. It means selling winners and buying losers. But this discipline improves returns over time by systematically buying low and selling high. The rebalancing threshold I use is 5 percentage points. If any allocation drifts more than 5 points from target, I rebalance. This prevents excessive trading while still maintaining the intended risk profile. I would also review the portfolio annually for any fundamental changes. Has a dividend aristocrat cut its dividend? That might be a sign of trouble worth investigating. Has a high-yield bond fund concentrated in a troubled sector? Perhaps it needs adjustment. Has inflation surprised to the upside, making tips more valuable than expected? These annual reviews catch potential problems early. Beyond rebalancing and annual reviews, I would not tinker. The temptation to optimize, to chase better returns, to react to market news, all of these lead to worse outcomes. The best thing you can do with a retirement portfolio is leave it alone. Let me address some common concerns I hear about this approach. Concern one is that the returns seem low. Will $200,000 actually grow over time? The answer is yes, but modestly. This portfolio is designed for income and stability, not aggressive growth. Total returns will probably be in the 5 to 7% range annually, which is lower than an all-stock portfolio in good years. But remember the principles I started with. Capital preservation comes first. A portfolio that returns 7% with low volatility beats a portfolio that returns 10% with high volatility for retirees. The volatility difference matters more than the return difference when you are withdrawing money and cannot afford big drawdowns. Concern two is that bonds are risky when interest rates are rising. This is a valid concern, which is why I emphasize high-yield bonds and TIPS rather than long-duration investment-grade bonds. High-yield bonds are less sensitive to rates. TIPS benefit from the inflation that typically accompanies rising rates. The bond allocation in this portfolio is designed to minimize interest rate risk. Concern three is that individual stocks might perform better than ETFs. Maybe. But individual stock selection introduces concentration risk that retirees cannot afford. If you own 30 individual stocks and one goes bankrupt, you lose 3% of your portfolio. If you own an ETF with hundreds of stocks and one goes bankrupt, you barely notice. Diversification matters more for retirement money than maximizing returns. Concern four is that $200,000 simply is not enough for retirement. This may be true depending on expenses, location, and lifestyle expectations. But $200,000 plus Social Security provides a reasonable foundation for many retirees. The strategies I have described work regardless of the specific dollar amount. Scale up or down based on your situation. Let me share some thoughts on what not to do with retirement money, because avoiding mistakes is often more important than making brilliant moves. Do not chase yield. When you see investments offering 10, 12, 15% yields, there is a reason. Either the risk is extremely high or the yield is not sustainable. Chasing yield leads retirees into investments that blow up spectacularly. Stick with proven income sources even if the yields seem modest. Do not try to time the market. Nobody, and I mean nobody, consistently times markets successfully. Retirees who try to time the market usually sell after crashes and buy after rallies, which is exactly backwards. Just stay invested according to your plan, regardless of what markets do. Do not concentrate in employer stock. I have seen retirees with 80 or 90% of their savings in the stock of the company they worked for. This is extremely dangerous. If that company struggles, you lose your job and your savings simultaneously. Diversify, even if you love the company you worked for. Do not ignore taxes. The location of your investments matters. High-yield bonds and other income-generating investments belong in tax-advantaged accounts where the income is not immediately taxable. Growth-oriented investments can go in taxable accounts where you control when to realize gains. Tax-efficient asset location can add meaningful returns over time. Do not neglect estate planning. A retirement portfolio is not just about your lifetime. It is also about what you leave behind. Make sure beneficiary designations are up to date. Consider whether a trust makes sense. Think about how to transfer wealth to the next generation efficiently. Let me also discuss how this portfolio performs in different market environments. In a bull market, this portfolio will lag an all-stock portfolio. The bonds, TIPS, and cash will hold back overall returns. The dividend stocks will participate in the rally, but probably not as aggressively as growth stocks. Expect to underperform during strong bull markets. This is the price of stability. In a bear market, this portfolio should hold up much better than an all-stock portfolio. The bonds and TIPS will likely rise as investors flee to safety. The dividend stocks will decline, but usually less than the overall market. The cash provides stability and potential buying opportunities. Expect to outperform during bear markets and corrections. In a stagflation environment with high inflation and slow growth, the TIPS allocation becomes particularly valuable. The inflation adjustment protects purchasing power. High-yield bonds may struggle if defaults rise, but the yield provides cushion. Dividend aristocrats typically have pricing power that allows them to pass through cost increases. This portfolio is reasonably well positioned for stagflation. In a recession, the focus on quality and income pays off. Dividend aristocrats continue paying dividends through recessions because they are mature, stable businesses. Utilities keep generating revenue because people still need electricity. The income stream continues even as stock prices decline. This provides the financial and emotional stability to stay invested. I want to close with some thoughts on the emotional side of retirement investing. Managing money for my parents, or for anyone you love, is different from managing abstract dollars. The stakes feel higher. The anxiety is greater. The responsibility is heavier. The portfolio I've described is designed not just for financial outcomes, but for emotional outcomes. When markets crash, my parents can look at their dividend checks still arriving and feel secure. When inflation spikes, they can see their tips adjusting upward and feel protected. When they need cash for an unexpected expense, they can access their liquidity buffer without selling stocks at a loss. This peace of mind is worth more than extra returns. What good is a portfolio that earns 2% more annually if it causes constant anxiety and sleepless nights? The best portfolio for retirees is one they can live with through all market conditions. When my father asked me that question at Thanksgiving dinner, what he really wanted was not the maximum return. He wanted security. He wanted to know that the money he had worked his whole life to save would take care of him and my mother. He wanted to stop worrying. The portfolio I have described delivers that security, not through complex strategies or brilliant market timing, but through diversification, income generation, and appropriate risk management. It is boring, it is simple, it works. If I had to invest $200,000 for my parents' retirement tomorrow, this is exactly what I would do. $80,000 in dividend aristocrats, $40,000 in high-yield bonds, $30,000 in utilities and infrastructure, $30,000 in tips, $20,000 in cash and short-term treasuries, total income around $8,000 per year. Stability, growth, and peace of mind. That is the portfolio, that is the approach, that is what I would do for the people I love most. And if it is good enough for them, it should be good enough for anyone facing the challenge of making retirement savings last a lifetime. But let me go deeper on some of these concepts because the details matter. Let me explain the specific thinking behind each allocation and how they work together as a system. The Dividend Aristocrat Foundation deserves more explanation because it is the core of the entire strategy. These are not just companies that pay dividends. These are companies that have demonstrated an almost fanatical commitment to returning cash to shareholders through every conceivable economic environment. Think about what it means to raise dividends for 25 consecutive years. That company raised dividends through the dot-com crash, through September 11th, through the great financial crisis, through the COVID pandemic, through every recession, every market panic, every moment when other companies were cutting dividends or going bankrupt. That is not luck. That is a fundamentally superior business model. The psychology of owning dividend aristocrats is also important. When you own these stocks, you think like a business owner rather than a stock trader. You do not obsess over daily price movements because you are focused on the dividend income. You know that as long as the dividends keep growing, the stock price will eventually follow. This long-term mindset leads to better decision-making. I have seen retirees who own individual growth stocks panic during every market correction. They check prices obsessively. They sell at bottoms. They buy at tops. But retirees who own dividend aristocrats often barely notice corrections. The dividends still arrive. The income still grows. The short-term price is just noise. The high-yield bond allocation also deserves deeper explanation because many people misunderstand this asset class. High-yield bonds are not gambling. They are a legitimate investment category with decades of performance data. The key insight is that the spread between high-yield bonds and treasury bonds compensates for more than actual default losses. Historically, high-yield spreads have averaged around 4 to 5% above treasuries, but actual default losses have averaged only around 2%. The extra spread is compensation for volatility and illiquidity risk, which long-term investors can capture. Said differently, if you hold high-yield bonds for a decade, you will almost certainly experience some defaults. But the extra interest you collect from the bonds that do not default more than compensates for the losses. The math works out in your favor over time. I also want to emphasize the diversification aspect. A single high-yield bond is risky. A portfolio of 300 high-yield bonds is actually quite stable. The defaults are predictable and manageable at the portfolio level. This is why I insist on using ETFs rather than individual bonds for this allocation. The utility allocation serves a specific purpose that goes beyond just income. Utilities provide what I call anti-correlation during market stress. When the market panics about economic growth, utility stocks often rise. Investors flee from cyclical stocks into defensive sectors. This means utilities can actually appreciate during market crashes when you need protection most. I saw this play out in 2020. While growth stocks were getting destroyed in March, utility stocks held up relatively well. They still declined, but much less than the overall market. This gave retirees breathing room and prevented the panic selling that destroys portfolios. The regulated nature of utilities also provides stability. Electric utilities operate under regulatory frameworks that guarantee them reasonable returns on invested capital. They cannot make spectacular returns, but they also cannot be competed away. The regulatory moat protects the business model indefinitely. The TIPS allocation addresses a risk that most retirees underestimate. We have lived through 4 decades of relatively low inflation. Many retirees have never experienced sustained high inflation and do not appreciate how devastating it can be. In the 1970s, inflation averaged over 7% annually for an entire decade. Retirees who held nominal bonds and cash saw their purchasing power cut in half. The money they saved became worth dramatically less. This was not a market crash. Their account balances did not decline, but the real value of their savings was destroyed nonetheless. TIPS provide insurance against this scenario. If inflation returns to 1970s levels, TIPS will adjust upward dramatically. The retirees who hold them will maintain their purchasing power, while those who do not will suffer. I view TIPS as insurance against a low probability but high impact event. The cash allocation is often the hardest to justify to people focused on returns. But let me tell you what happens without adequate cash reserves. Imagine my parents need $30,000 for an unexpected medical expense. If they have no cash buffer, they must sell stocks to raise that money. If the market happens to be down 20% when they need the cash, they are selling at the worst possible time. They lock in losses and permanently reduce their portfolio value. Now imagine they have $20,000 in cash reserves. They can cover most of the expense without selling stocks. Their investments remain intact to recover when markets rebound. The cash buffer prevented a permanent impairment of their wealth. This scenario plays out constantly for retirees. Cars break down, roofs need replacing, medical bills arrive, life happens. Having cash available means these inevitable expenses do not force bad investment decisions. Let me also discuss the sequence of returns risk in more detail, because this is one of the biggest threats to retirement security. Sequence of returns risk means that the order of investment returns matters enormously for retirees. 2 portfolios can have identical average returns over 20 years, but dramatically different outcomes depending on when the good and bad years occur. Consider 2 scenarios. In scenario 1, markets decline 20% in the first year of retirement, then recover and average 8% for the remaining years. In scenario 2, markets average 8% for most of retirement, then decline 20% in year 19. Both scenarios have similar average returns, but the retiree in scenario 1 runs out of money much faster. Why? Because they were withdrawing money during the decline. They sold shares at low prices. Those shares were not available to participate in the recovery. The early bad years permanently impaired the portfolio. The retiree in scenario 2 had nearly 20 years for the portfolio to grow before the decline. Even after a 20% drop in year 19, they likely had enough to last the remaining years. This is why the cash buffer and income focus matter so much. If my parents can fund several years of expenses from income and cash reserves, they never have to sell stocks during a crash. They avoid the sequence of returns risks that destroys so many retirement portfolios. Let me share some thoughts on how to actually implement this portfolio in practice. If my parents have existing retirement accounts with random holdings, I would not make all the changes at once. Sudden wholesale changes can trigger tax consequences and feel emotionally disruptive. Instead, I would transition gradually over 6 to 12 months. First, I would sell any obviously problematic holdings. Speculative stocks, concentrated positions in former employers, expensive actively managed funds. These should go immediately because the risks are not worth the tax costs of selling. Second, I would establish the target allocation in any new contributions. Going forward, all new money goes into the 5-component structure I described. Third, I would gradually rebalance existing holdings toward the target. Each quarter, I would shift a portion of the portfolio closer to the ideal allocation. Within a year, the portfolio would be fully aligned with the strategy. This gradual approach also provides time to dollar cost average into positions. If markets decline during the transition period, new purchases happen at lower prices. If markets rise, the existing holdings benefit. Either way, the risk of terrible timing is reduced. For account types, I would prioritize tax-advantaged accounts for the income-generating investments. High-yield bonds belong in IRAs, where the income is not immediately taxable. REITs within the utility allocation should also go in tax-advantaged accounts because their dividends are mostly ordinary income. The dividend aristocrats can go in taxable accounts because qualified dividends receive favorable tax treatment. Tips can go in either account type depending on other factors. The cash allocation should be split. Some cash belongs in taxable accounts for easy access. Some can stay in tax-advantaged accounts as part of the overall allocation. Let me also address what happens as my parents age. The portfolio I described is appropriate for someone in their 60s or early 70s, but as they move into their 80s and beyond, some adjustments make sense. The equity allocation might decrease modestly as life expectancy shortens. If my parents reach 85, they have fewer years for stocks to recover from a crash. A somewhat more conservative allocation reduces anxiety without significantly impacting outcomes over a shorter time horizon. The income focus becomes even more important. By the late years of retirement, predictable income matters more than growth potential. Shifting slightly toward bonds and away from stocks can increase income stability. Required minimum distributions also become a factor. Starting at age 73, retirees must withdraw minimum amounts from traditional IRAs each year. This forced selling can be managed by holding less volatile assets in IRAs, so the required sales are not happening during market crashes. One thing that should not change is the focus on simplicity and low costs. In fact, simplicity becomes more important as people age. If my father develops cognitive decline, a complex portfolio becomes impossible to manage. A simple portfolio of 5 ETFs can be maintained by anyone, including successor trustees or family members who step in to help. I want to close by acknowledging that this portfolio will not make anyone rich. It will not double in value next year. It will not provide cocktail party stories about brilliant market calls. But it will do something more important. It will provide security. It will generate income. It will protect against the scenarios that destroy retirement plans. It will let my parents enjoy their remaining years without financial anxiety. When I think about what I want for my parents, it is not maximum returns. It is peace of mind. It is knowing they can pay their bills. It is confidence that unexpected expenses will not derail their security. It is the freedom to focus on family, hobbies, and experiences rather than stock prices. The portfolio I have described delivers all of that. It is the answer I would give my father if he asked me that question today. It is what I would do for the people I love. And it is what I recommend for anyone who has worked hard, saved diligently, and deserves a retirement free from financial worry. $200,000. 5 simple allocations. Income, stability, and peace of mind for life. That is the portfolio. That is the approach. And that is how I would invest for my parents' retirement.